Silver plummets 22% in 2 hours. What just happened? $90 to 73 in just 120 minutes. While most of the Western world slept, something happened in Shanghai that hasn't been seen in precious metals markets in over 4 decades. 3 million ounces vanished from vaults the day before. Physical metal flying out the door, yet the price collapsed like a controlled demolition. China still paying a $10 premium, even after the carnage. This wasn't a market correction, this was precision. And what it reveals about the global monetary system might be the most important economic signal of this entire decade. The question isn't just what happened, it's what happens next. Welcome to Metal and Macro. If you've spent decades watching markets, if you remember when financial news meant something more than entertainment, then you know why you're here. This channel exists for those who understand that real wealth isn't built on hype. It's built on information, analysis, and timing. Now, if this kind of strategic economic insight matters to you, if you're tired of surface-level commentary and want the structural story behind the headlines, do yourself a favor, hit that subscribe button. Think of it this way, you wouldn't ignore a warning light on your dashboard, would you? Consider this your financial dashboard, and we'd genuinely like to know, where in the world are you watching this from today? Drop your city or country in the comments below. Now, let's see how global this community really is. Now, let's get into what actually happened. On the night of February 4th, 2025, while traders in New York and London had closed their screens and gone home, something extraordinary unfolded in Shanghai. Silver, a metal that had been climbing steadily for weeks, suddenly collapsed. $90 per ounce to $73 in just 2 hours. A 22% free fall that erased billions in value before most Western investors even knew what was happening. This wasn't gradual. This wasn't a slow decline that gave traders time to think or react. This was violent, calculated, surgical. The Shanghai Futures Exchange became ground zero for one of the most dramatic price dislocations in modern commodity market history. At precisely 9:47 p.m. Shanghai time, the selling began. Wave after wave of contracts flooded the market. The price ticked down, then tumbled, then outright crashed. By the time Western markets opened hours later, the damage was done. Spot silver in New York sat at $75. Futures contracts hovered around $76. But here's where it gets interesting. In Shanghai, physical silver spot prices held at $86. Shanghai futures still trading at $90. A $10 to $15 premium, even after the crash. Think about that for a moment. The same metal, the same global market, but two completely different price realities separated by geography and market structure. When Western traders logged in that morning, confusion spread quickly. Trading desks scrambled to understand what had happened overnight. Risk managers recalculated positions. Margin calls went out to leveraged accounts that had been wiped out in their sleep. The speed of the decline revealed something critical about modern silver markets, something most participants didn't want to acknowledge. Liquidity, the lifeblood of any functioning market, had completely evaporated during those 2 hours. In stable markets, large sell orders get absorbed gradually. Buyers step in at lower prices. The market finds balance. But during this event, there were no meaningful buyers. The bids simply disappeared. Every attempt to sell pushed prices lower, which triggered more selling, which pushed prices even lower. This is what traders call a cascading liquidation. Leveraged positions that had bet on silver continuing to rise suddenly faced margin calls. When traders couldn't meet those calls, their positions were automatically closed by exchanges. Those forced sales added more selling pressure. The cycle fed on itself. Algorithmic trading systems, computer programs, designed to buy and sell based on price patterns, made everything worse. These systems detected the downward momentum and added to the selling. In milliseconds, thousands of orders flooded the market. What might have been a sharp correction became an all-out collapse. But here's what separates this event from a simple market panic. The timing. The crash happened during Asian trading hours when Western liquidity providers were offline. The Shanghai Futures Exchange operates in a different time zone than COMEX in New York or the London spot market. This created a window, a gap in global market coverage, where prices could be moved with less resistance. Experienced market observers noted something else. The selling wasn't random or panicked, it was methodical. Large blocks of contracts hit the market at specific intervals. The pattern suggested coordination, not chaos. Gold, silver's sister metal, barely moved. It held steady around $3,021 per ounce. Normally, gold and silver move together. They're correlated assets. When one falls, the other typically follows, but not this time. This divergence raised questions. If the crash was driven by fundamental economic concerns, by fears about global growth or currency stability, gold should have fallen too. But it didn't. The maintained premium in Chinese physical markets told another story entirely. While paper contracts in Shanghai Futures crashed, the actual physical metal, the bars and coins that people could hold, still commanded higher prices. Buyers in China were still willing to pay $86 to $90 per ounce for actual delivery. This created a bizarre situation. In the West, silver appeared to be in freefall. In the East, physical buyers saw opportunity and kept bidding. The disconnect between paper prices and physical premiums would become the central mystery of this entire event. Because when physical metal commands a premium during a price crash, something is fundamentally broken in the pricing mechanism. And what happened in the days leading up to this collapse would make that break even more obvious. Every crash has a story that begins long before the first price ticked downward. And this one had been whispering warnings for nearly 3 weeks, but most people weren't listening. Throughout mid-January, silver had been on a relentless march upward. Day after day, the price climbed. Excitement built in trading communities. Social media filled with predictions of silver reaching $100, then $150. Some even called for $200. The momentum felt unstoppable, but experienced traders, the ones who had survived previous precious metal cycles, were watching something else entirely. They were watching an invisible ceiling that silver kept hitting and failing to break through, $87 to $90 per ounce. This wasn't just a random price level. It was a zone where something changed, where buying enthusiasm met something stronger, where the upward momentum, no matter how powerful, came to die. The first test came on January 22nd. Silver pushed to $88 in Asian trading. Volume surged. Bulls celebrated. But by the daily close, the price had retreated to 85. The body of the candlestick, the range between opening and closing prices, sat firmly below the $90 mark. Rejection number 1. 3 days later, another attempt. This time, silver briefly touched $89.70, so close to the psychological $90 barrier. Traders holding long positions prepared for the breakout. Options buyers bet on $95 and $100 strikes. But the close, $86.20. Rejection number 2. On January 29th, the most aggressive push yet. Silver spiked to $90.40 in overnight trading. Headlines screamed about silver's historic rally. Retail investors piled in, afraid of missing out. Leverage ratios on futures exchanges hit multi-year highs. The daily close, $87.10. Rejection number 3. This pattern, this repeated failure to establish a daily close above 90, was telling a story that most market participants refused to hear. Someone, or some group, was systematically selling into every rally attempt at that level. But while the price action was sending warning signals above ground, something far more interesting was happening below the surface, in the vaults. The physical metal was moving. On February 4th, the very day before the crash, something unprecedented occurred at COMEX warehouses in New York and Delaware. 3 million ounces of silver vanished from registered vaults in a single 24-hour period. To put that in perspective, on an average day, COMEX might see withdrawals of 200 to 400,000 ounces. Large withdrawal days might hit 800,000 ounces. 3 million ounces wasn't normal. It was extraordinary. The breakdown was even more revealing. Asahi Refining, and one of the world's largest precious metals refiners, withdrew 1,970,000 ounces, nearly 2 million ounces removed from the system in one move. HSBC, the British banking giant with deep ties to Asian precious metals markets, pulled 907,000 ounces. Even JP Morgan, the bank that had been fined hundreds of millions of dollars for previous precious metals market manipulation, withdrew 282,000 ounces. And Loomis, a major secure logistics company, adjusted 2.5 million ounces from registered to eligible inventory. The registered category is critical. These are bars that are available for immediate delivery against futures contracts. When metal moves out of registered, it means less physical silver backs, the paper contracts trading on the exchange. After that single day's activity, total COMEX silver inventory dropped to 400 million ounces. In a market where billions of dollars in paper contracts trade daily, 400 million ounces of physical backing isn't much of a cushion. Now here's where the story gets strange. In normal market logic, when physical metal is being drained from vaults, when supply is visibly leaving the system, prices should rise. That's basic economics. Scarcity drives value, but that's not what happened. While 3 million ounces walked out the door, while vault inventories hit multi-year lows, while physical demand was clearly surging, the paper price was being rejected at $90, over and over again. It was as if two completely separate markets were operating. The physical market, where real metal changed hands and moved across continents, was screaming scarcity. The paper market, where contracts and derivatives traded electronically, was screaming resistance and distribution. Analysts who tracked both markets noticed the divergence immediately. Some called it unusual, others called it suspicious. A few, the ones who had studied precious metals markets for decades, called it exactly what they'd seen before, the pattern of a controlled takedown. Because in the history of silver markets, massive vault withdrawals combined with price rejection at key technical levels had preceded every major orchestrated sell-off. Every single time, the same fingerprints. Physical metal leaving the system while paper prices got slammed at resistance zones. And every single time, it created opportunity for those who understood what was really happening. The question wasn't whether a crash was coming. The question was who knew it was coming and what they were preparing to do when it arrived. There's a moment in every market collapse when the official explanations stop making sense, when the neat narratives about profit-taking and technical corrections start to crack under the weight of evidence. This was that moment for silver, because beneath the surface of this 22% crash, beneath the headlines and the panic, there existed a network of institutional forces that most retail investors never see. And understanding these forces separates those who get destroyed in market chaos from those who profit from it. Let's start with the ETFs. Exchange-traded funds like SLV, the iShares Silver Trust, are supposed to be simple. Investors buy shares. The fund buys physical silver. Share price tracks silver price. Clean and transparent. Except it's not that simple. In the 3 weeks leading up to the crash, something odd was happening with silver ETF flows. Institutional investors, the pension funds, hedge funds, and family offices that move serious money were quietly redeeming shares. Not panic selling, not mass exodus. Just steady, consistent redemptions. By the end of January, SLV had seen outflows of nearly $40 million. Other silver ETFs showed similar patterns. SIVR, the Aberdeen Standard, physical silver shares, ETF, recorded 12 consecutive days of negative flows. Now, here's the mechanism most people miss. When investors redeem ETF shares, the fund doesn't necessarily sell physical silver immediately. There's a process involving authorized participants, large financial institutions that create and destroy ETF shares. These participants have the ability to exchange shares for physical metal or vice versa. During periods of high redemption, authorized participants can short sell silver futures to hedge their exposure while they arrange physical delivery. This creates downward pressure on paper prices, even as physical metal is being withdrawn from the system. It's a perfectly legal arbitrage mechanism, but it's also a perfect way to suppress prices while accumulating physical metal. The timing of these ETF flows, ending just days before the crash, suggested that sophisticated players knew something was coming. Then there were the central banks. The Federal Reserve's position on precious metals has always been complicated. Officially, the Fed doesn't target gold or silver prices. Officially, these markets are free and fair. Unofficially, the Fed has every incentive to prevent precious metals from signaling dollar weakness. When silver rallies violently, when it approaches psychologically significant levels like $100 per ounce, it sends a message to global markets, a message that faith in fiat currency might be cracking, that inflation fears might be justified, that the monetary experiment of the past 15 years might be failing. Central banks can't allow that message to take hold. They don't need to directly intervene in silver markets to influence prices. They simply need to coordinate with the bullion banks that act as market makers. A phone call here, a policy signal there, implicit permission for aggressive hedging strategies. And on the other side of the world, the People's Bank of China was doing something entirely different. While Western central banks wanted silver contained, China wanted silver accumulated. Data from the Shanghai Gold Exchange showed that Chinese institutions had been steadily increasing their physical precious metals holdings throughout 2024 and into 2025. Gold purchases hit record levels, silver imports surged. But here's the strategic genius of China's approach. They weren't buying into rallies. They weren't chasing prices higher. They were waiting for crashes, for moments of maximum Western panic, to step in and acquire physical metal at discounted prices. The $10 to $15 premium that persisted in Chinese physical markets even during the crash? That wasn't irrational. That was strategic positioning. China understood something that most Western traders missed. In a world where paper contracts can be created infinitely, physical metal is the only true store of value. Now we arrive at the question nobody in official financial circles wants to discuss honestly. Manipulation. The word itself triggers defensive reactions from regulators and industry associations. They'll point to market complexity, to legitimate hedging activities, to the natural volatility of commodity markets. But the evidence isn't circumstantial anymore. In 2220, JP Morgan paid $920 million to settle charges of precious metals market manipulation. The bank admitted to thousands of instances of spoofing, placing fake orders to move prices, then canceling those orders before execution. Traders at the bank described it as standard practice, something they'd done for years, something their supervisors knew about and encouraged. That settlement was supposed to clean up the market, supposed to restore integrity to precious metals trading. Yet here we were, 5 years later, watching the exact same patterns play out. Concentrated short positions held by a small group of bullion banks, massive sell orders hitting the market during low liquidity hours, price movements that bore no relationship to physical supply and demand fundamentals. The CFTC, the Commodity Futures Trading Commission, publishes weekly data on trader positioning through its Commitments of Traders reports. In the weeks before the crash, commercial traders, the category that includes bullion banks, had built their largest net short position in silver since 2021. These weren't hedges against mining production. Most major silver miners had already locked in prices for 2025 production. These were speculative shorts, bets that prices would fall, and they were concentrated in just 4 or 5 large institutions. When a small group holds enough short contracts to move an entire market, when those same institutions serve as market makers with access to order flow data, when they've been caught and fined for manipulation before, the question isn't whether manipulation is possible. The question is why anyone would believe it isn't happening. But here's what matters more than assigning blame. Understanding these structural forces, these institutional dynamics, allows informed observers to position themselves correctly. Because while retail traders were panicking during the crash, and while over-leveraged speculators were getting margin calls, someone was buying. Physical buyers in Asia, strategic accumulators who understood that paper price crashes create physical accumulation opportunities. Institutions that think in decades, not days. The crash wasn't the end of silver's story. It was a transfer of wealth from those who understood paper markets to those who understood the difference between price and value, and what that means for the future, for the broader monetary system. For anyone trying to preserve wealth in an unstable world, that's where this story gets really interesting. Every financial earthquake leaves cracks in the system that weren't visible before, and this silver crash, this 22% overnight collapse, exposed fault lines that run far deeper than most people realize, because this wasn't just about one metal having a bad night. This was a window into how modern markets actually function when stress enters the system. And what that window revealed should concern anyone who holds wealth in any form. Let's start with the immediate consequences. Within hours of the crash, margin calls rippled through the commodity futures complex. Traders who had leveraged positions in silver, using borrowed money to amplify their bets, suddenly faced demands for additional capital. Many couldn't meet those demands. Their positions were liquidated automatically. Accounts that had been worth hundreds of thousands of dollars, gone in minutes. Some traders lost everything they'd built over years of successful trading. But the damage didn't stop at silver. Correlation models that institutional investors rely on, the mathematical relationships between different assets, broke down completely. Silver crashed while gold held steady. Copper barely moved. Platinum and palladium showed no reaction. This shouldn't happen in normal market conditions. Precious metals tend to move together. When one falls, others follow, but not this time. Portfolio managers who had hedged their precious metals exposure based on historical correlations suddenly found those hedges worthless. Risk models that had worked for years stopped working overnight. For mining companies, particularly the smaller silver producers, the crash created an existential crisis. Many of these companies had used future production as collateral for loans. When silver prices collapsed, the value of that collateral evaporated. Banks started making calls. Credit lines got pulled. Projects that were profitable at $90 per ounce became money-losing operations at $73. Within the mining sector, analysts estimated that nearly 40% of global silver production became uneconomical at post-crash prices. That meant mines would close, workers would be laid off, future supply would shrink. Ironically, the price crash guaranteed future supply shortages, but here's where the story splits into 2 completely different realities. For paper traders, those who held futures, contracts, options, or ETF shares, the crash was devastating. Their wealth existed as digital entries in brokerage accounts. When prices fell, that wealth simply disappeared. No appeals process, no way to argue with the market, just gone. For physical holders, those who owned actual bars and coins stored in vaults or safes, the experience was entirely different. Yes, the spot price had fallen. Yes, their holdings were worth less in dollar terms, but they still held the same amount of metal, the same ounces, the same weight. And something interesting happened in physical markets after the crash. Premiums exploded. Coin dealers reported unprecedented demand. Buyers who had been hesitant at $90 suddenly rushed to purchase at $75. Online bullion retailers sold out of inventory within hours. Delivery times stretched from days to weeks. The paper price said silver was worth $73. The physical market said it was worth $85, $90. In some cases, even higher for immediate delivery. This created a massive arbitrage opportunity, but only for those who understood what was happening. Sophisticated buyers recognized that paper crashes and manipulated markets create physical buying opportunities. They understood that price and value are not the same thing. Price is what you pay, value is what you get. And the value of physical silver, its industrial applications, its monetary history, its scarcity as a finite resource, hadn't changed at all. Now let's zoom out to the bigger picture. What does extreme volatility in precious metals markets tell us about the broader financial system? It tells us that the mechanisms for price discovery, the processes by which markets determine fair value, are broken. When 3 million ounces can leave vaults while prices get rejected at resistance levels, when paper contracts trade at massive discounts to physical delivery prices, when crashes happen in low liquidity windows with surgical precision. These aren't signs of healthy, functioning markets. These are signs of markets under control, markets being managed, markets where price no longer reflects supply and demand fundamentals. And if silver markets can be manipulated, this obviously, what about other markets? What about bonds, where central banks are the largest buyers? What about stocks, where corporate buybacks distort valuations? What about currencies, where intervention is official policy? The silver crash was a reminder that in modern financial markets, very little is what it appears to be. For serious wealth allocators, for family offices, pension funds, and individuals trying to preserve capital across generations, this raises critical questions. Can paper assets be trusted when the underlying markets are this fragile? Can digital wealth, numbers on screens, survive the kind of coordinated actions that just erased billions in silver value? Throughout history, during every period of monetary instability, currency crisis, or financial collapse, one pattern has held constant. Physical assets survive. Paper promises fail. The Romans learned this when their denarius was debased. The Germans learned it during Weimar hyperinflation. The Zimbabweans learned it in 2008. The Venezuelans are learning it right now. And this silver crash, this seemingly isolated event in one commodity market, was actually a microcosm of a much larger problem. The problem of a global monetary system built on debt, leverage, and the assumption that central banks can manage everything forever. That assumption is being tested. Silver's crash and the persistent premium in physical markets revealed the test in real time. So, what should informed observers do with this information? First, understand the difference between trading and investing. Trading is about capturing short-term price movements. Investing is about preserving and growing wealth over time. The crash destroyed traders. It created opportunity for investors. Second, recognize that physical possession matters. In a world where paper markets can be manipulated, physical assets offer protection that digital entries cannot. Third, time horizon determines strategy. If someone needs liquidity next month, volatility is dangerous. If someone is building wealth for the next decade, volatility is opportunity. And finally, pay attention to what central banks and sovereign nations do, not what they say. China maintained premiums and kept buying physical metal during the crash. That action speaks louder than any official statement about currency policy or trade relations. The silver crash of February 2025 will be studied for years. Some will see it as proof that precious metals are too volatile for serious portfolios. Others will see it as proof that markets are manipulated and paper assets are dangerous. But the wisest observers will see it as something else entirely. A warning, a signal that the monetary system is under more stress than official sources acknowledge, that the mechanisms for maintaining order in financial markets are becoming more aggressive and more obvious, that the gap between paper prices and physical reality is widening, and that gap, that disconnect between what markets say and what physical assets are worth, that's where the next crisis begins. The question isn't whether another crash will come. The question is whether observers will recognize the warning signs and position themselves accordingly before it's too late.